Hello there, and a very warm welcome to The Financial Equation. Isn't it a curious thing, the way we think about money? For most, it's a rather frantic scramble from one pay slip to the next. But for a select few, the truly wealthy, money behaves quite differently. It isn't just something to be spent, it's something to be grown, nurtured, passed down through generations like a treasured family story. They achieve this not through some dark magic, but with a tool that is, in essence, surprisingly simple. They build their own bank, a family bank. Its cornerstone is something called a trust. It sounds terribly grand and intimidating, as if it belongs only in wood-paneled rooms filled with stern-faced solicitors. But the basic idea is no more complicated than a piggy bank, albeit a rather sophisticated one with a few more rules. A family bank is not a literal bank with a vault and tellers. It is a formal structure, most often a trust, designed to hold and manage a family's collective wealth. Its purpose is to support family members, fund their dreams, educate the next generation, ensure the family's financial security for decades or even centuries. It's about shifting from a mindset of individual earning to one of collective stewardship. It is a profoundly powerful concept that changes the entire financial dynamic of a family, turning fleeting wealth into a lasting legacy. The beauty of this approach lies in its structure and its foresight. Instead of handing over a lump sum to a young adult, which might be spent with more enthusiasm than wisdom, the family bank provides resources in a controlled, purposeful way. It can lend money for a first home, provide a grant for a promising business venture, fund a grandchild's university education. It operates with a set of rules and values established by the family itself, ensuring that the wealth is used to build, not to spoil. This isn't about control for control's sake. It's about providing a safety net and a launch pad all in one. So let's demystify this whole affair, shall we? And we're going to peel back the layers of jargon and complexity that so often surround trusts and estate planning. We will explore, step by step, how one goes about creating such a structure. We'll discuss how to manage it, how to make decisions as a family, and how to avoid the common squabbles that can so easily arise when money is involved. Think of this as your friendly guide, your financial QI, if you will. By the end, the idea of a family bank will seem less like an unobtainable secret of the super rich and more like a rather sensible and achievable goal for any family with the foresight to plan for its future. Right then, let's get our hands dirty. Where does one begin? The very first step in building your family bank is to create its legal foundation, the trust. Now, a trust is simply a legal arrangement. You, the person creating the trust, let's call you the grantor, hand over assets to a trustee. The trustee is a person or an institution you appoint to manage these assets for the benefit of others, who are known as the beneficiaries, your children, grandchildren. The entire process begins not with a lawyer, but with a conversation. You must first define your why. Why are you doing this? Is it to fund education, to encourage entrepreneurship, to provide housing? Your purpose will shape every decision that follows. Once you have your why, assemble your team of professionals. This is not a do-it-yourself project. You will need an experienced estate planning lawyer. This is non-negotiable. They will draft the trust deed, the blueprint for your family bank. You should also consult a financial advisor and an accountant. The advisor helps you decide which assets to put into the trust: cash, property, investments. The accountant ensures everything is structured in the most tax-efficient way possible. Think of them as your master builders and engineers. With your professional team in place, you move on to the paperwork. The lawyer will draft the trust document based on your goals. This document is the heart of your family bank. It will name the grantor, the initial trustees, and the beneficiaries. It will lay out all the rules of the road, how money can be distributed, for what purposes, and under what conditions. For instance, funds for university tuition, but only if the student maintains a certain grade average, or a loan for a house deposit repaid with a low interest rate. This is where you embed your family's values into its financial DNA. The final step is funding the trust. A trust without assets is like a car without an engine. This involves transferring ownership of chosen assets from your name into the trust's name. Once assets are in the trust, they are no longer technically yours. They are owned by the trust and managed by the trustee for the beneficiaries. Now that the trust exists, we must give it shape and function. How does it actually operate as a bank? Don't think of it as a static pot of gold. Think of it as a dynamic financial institution. It needs policies and procedures. The trust document is the constitution. You still need a day-to-day operating manual. Decide on the products your family bank will offer: grants, education, charity work, loans, replenish capital for future generations. Often you offer both: educational grants that don't need repayment, loans for a business startup, loans for a home, down payment. Define the terms of those loans. What will the interest rate be? Peg it to a government rate. For example, the applicable federal rate. That keeps it above board legally. It also often beats commercial bank rates. It's about opportunity, not profit. Decide how family members will interact with the bank. Create a formal application process. A beneficiary shouldn't just call the trustee and request funds. They submit a formal proposal. The proposal shows what the money is for, how it aligns with the family's values and mission, and, if a loan, a clear repayment plan. This isn't bureaucratic red tape. It's encouraging thoughtfulness, responsibility, financial literacy. It teaches family members to build a business case. Finally, create separate pools of capital, a main investment pool for long-term growth managed by advisors, a smaller liquid lending pool for loans that protects core capital from depletion. This structure gives clarity and sustainability. It helps the current generation while preserving wealth for the next. It's a delicate, brilliant balancing act. Section 4. Keeping the engine humming, running the trust day to day. A family bank, like any institution, requires ongoing maintenance to run smoothly. The day-to-day administration is the unglamorous but utterly essential work that keeps the dream alive. At the core of this is meticulous record-keeping. Every single transaction, whether it's an investment return, a bank fee, a grant for tuition, or a loan disbursement, must be tracked. This is typically the responsibility of the trustee, who might delegate the task to a bookkeeper or an accountant. These records are vital for tax purposes, as trusts have their own specific filing requirements, and for maintaining transparency within the family. Without clear records, misunderstandings and mistrust are almost inevitable. Regular meetings are the lifeblood of a well-run family bank. The trustees should meet at least quarterly to review the trust's investment performance. Consider any new funding requests from beneficiaries and discuss administrative matters. However, it's also wise to hold an annual family meeting that includes all the beneficiaries, even the younger ones. The question of who holds the power is often the trickiest one to navigate in a family enterprise. In a family bank, this power rests with the trustee, or more commonly, a board of trustees. Choosing the right trustees is arguably the most critical decision you will make. The initial grantor often serves as the first trustee, but a plan for succession is vital. You could appoint a single, highly trusted family member, but this can place an immense burden on one person and open the door to conflicts of interest. A more robust approach is to create a trustee committee. The inclusion of an independent trustee is one of the most valuable insider secrets of wealthy families. Their role is to provide an objective, unemotional perspective. As with any grand venture, building a family bank is fraught with potential pitfalls. One of the most common traps is a lack of clarity. If the trust's purpose and rules are vague, it becomes a recipe for disaster. Another significant pitfall is the curse of entitlement. Beneficiaries may see the family bank as an infinite source of free money. Successful families build a culture of stewardship, not entitlement. And above all, communicate. Transparency is the antidote to the suspicion and resentment that so often corrodes family fortunes.